We've seen a lot of different startups promising quicker routes to the market with their technology, but we have not seen that materialize ever. So at least my personal view is that these things just take a couple of years of, even if you have the product ready in a test environment, before you have it ready in a commercial environment, this requires some years of iterations and testing, and there doesn't seem to be a route around it at this stage. Okay, thank you. Thank you for having me on this podcast. My name is Jaap Zijlstra. I work for Navus. Navus is a Dutch VC, part of a family office. And we are basically trying to build clusters of successful tech companies in sustainable food and energy. So we come from a background, or the family that we invest for has a background in machinery and robotics, and has been very innovative in those spaces. And we focus on different angles, but we do try to bring all the experience from the family in developing tech and scaling tech around the world for our portfolio companies. And we now have around 25. And to make it a bit more specific than food and energy, I think in food, we do a lot of controlled environment agriculture, so robotics and automation, also a bit of open field ag. We do alt protein or alternative ingredients, and then we like to focus on the production technology side of that. And we also look at energy. Yeah, that's in short. I think we invest a lot in different stages. So often it's seed or A, but we have done pre-seed. We have a couple of private equity investments. And we are, we're not a fund in a strict sense. So we invest from the balance sheet of a family office, so we can be a shareholder for longer as well. Yeah, meaning that a typical ticket can be 1 or 2 million, but if it's a private equity deal, it can be a lot more. And if it's pre-seed, it can also be a lot less. And we typically keep investing in our portfolio companies as they scale.
Mm-hmm. Amazing. And what's the geography like? Where do you guys focus geography-wise?
Yeah, we like to have a meaningful stake and involvement. So we like a bit of proximity to where we are based in the Netherlands, and everything Northwestern Europe works for us. But I think, let's say 70% of the portfolio ends up being in the Netherlands or close to it.
Okay, great. But you would look at a geographically far, like 30% you're saying is reserved to global opportunities as well? Or you would say, if it's outside Northern Europe, it's probably not a fit.
Yeah, so Northwestern Europe typically. So we have one in UK, one in Sweden, Switzerland. Yeah, that's more or less the logical scope. But I mean, since we're not a fund, we can look at things case by case. And if there's this great fit with a US company, we could incidentally invest there as well.
Okay, perfect. Excellent. Now, you guys recently made a great investment. A good friend of mine, also, another guest on the podcast, Kosek. How did that fit into your thesis? Like, how does that look? Because they're essentially a high value ingredients company. I don't know if they have a machinery component to their structure. I think using precision fermentation, I could be wrong, but why was that fit to your family thesis? Why did you decide to make that bet?
Yeah, so we invested first, let's say 2 years ago, and we reinvested in the recent round of Kosek. And what we liked and still like is the process technology. So indeed, they sell in the end ingredients, but there's a significant part of IP in how they do the biomass fermentation, how they process the yeast to get to the end products. And we think they are really disruptive there and have the potential to replace a lot of cream and other products at unit economics that makes sense. So I think that was the main trigger, the fact that they can use fermentation to get to a price that's comparable to the alternatives that they're replacing.
Mm-hmm. So you're looking at unit economics. So I'm guessing specialty ingredients was an important component of that would allow you to get higher price points for your. It wasn't just a commodity replacement.
Well, yeah, it shouldn't be too niche because then we don't have the knowledge. But typically we see applications in more high value ingredients first. But we do think that Kosek has the potential to, for instance, replace the cream that you use in the kitchen every day in the end. So yeah, we are looking for the potential mass market application and having it make a real impact on a sizable part of the market.
And if, say, I'm listening to this podcast and I'm thinking, gosh, am I a good fit or not? I go through, okay, I'm in the right geography, let's say. Okay, great. I am maybe it sounds like a B2B solution. I am doing a
Yeah.
process, some sort of deep technology IP. Okay, great. If what is the process like of actually getting investment from you? What can you take us through step by step? How long would I expect the process take? What does the diligence look like? And if I reach out today, what will happen?
So when to start the process, that we often have a long standing discussion, or we know the founders already for a while. So for instance, to take the Cosaic example, they were introduced to us to one of their existing adventure investors 2 years ago. And then we met at X Summit, I think. And then we started, when the process from their end really started, and when the due diligence from our end really started, then I guess we focus first on the IP and technology that needs to be unique and defendable. We focus on the unit economics, or in this case, the techno-economic analysis. And when we talk to people in the industry, potential clients, etc., to get a bit of comfort on the commercial side. And when we've covered those topics, I'm making it a bit easier than it sounds, but then we try to come up with a term sheet. We often lead or co-lead, although we also can follow. So we try to get some level of term sheet level agreement, but then we already are quite comfortable on the technology and the commercial prospects. And then after the term sheet, we move into the detailed due diligence, which is more of a confirmatory nature. And then we still need to build consortium and do some tie up some details here and there in the negotiation. So when you ask how long will this take, I think I would say from the moment that we're properly introduced and from both sides working on towards the term sheet, then I would say at least 2 or 3 months. And then post term sheet, I mean, we can do that in a month, but it often takes longer because of consortium building and other external factors. And if you look at our internal process, we introduce a company just to check the fit, whether it fits our strategy, whether it fits our background and expertise, and we can uniquely add something to this company. And then we do the due diligence part, the commercial and technical due diligence part, and then we issue a proposal to our investment committee. And if they agree, then we're usually good to go from that point onwards. So we need two interactions with our AC, and the process I just described moves along these lines.
Okay, great. And then the way you described it is it could be a term sheet offered, and then another stage of due diligence is triggered, and then only a formal offer.
No, so sorry for being unclear in that sense. So you usually have we meet a startup, we have a couple of conversations, we get really confident on the startup within our team. Then we propose to spend a lot of time on it to our investment committee by introducing the company to our investment committee. Then we do most of, let's say, the commercial technology team, the key due diligence topics. Then we get to a term sheet level agreement, but just prior to the term sheet or around the term sheet, we need to confirm the investment with our IC. And after that, it's confirmatory due diligence negotiations about details, etc. So those are the steps.
Okay. You mentioned something a few times, which is this notion of we want to bring additional value, and that's a differentiator. Like, how do you gauge that? Like, what additional value can you bring to Cosaic, for example, without sharing too much? Like, what is the additional value that you can see, in that recent investment that you can provide?
I mean, the first line is our team, and we are investing in certain topics. So we get experienced on, for instance, alt proteins or ag robotics, and we can facilitate. But I guess most VCs do that, right? So it's the strategy, the finance, the links within the portfolio into other investors. So that's the first step. Then we have a broader group around us, which is our sister company, which is, as I mentioned, like a established ag machinery company. And we have people experienced in product development there, in IP and patents, in supply chain, in biotech, all kinds of topics. And we can use those people to help our startups on a case-by-case basis. So for instance, Cosaic we can help with their IP strategy, or for instance, when they have a complex partnership contract, maybe somebody can help from the broader group we're in. So we're not a corporate VC in any way, but we're trying to bring a bit of the benefits from the experience that the family has in the tech business scaling part.
Yeah. Yeah, that's very, very clear. Anything about the IP due diligence that you guys are doing? Because you don't necessarily have on staff an expert on, for example, precision fermentation technology, right? Is that something you would bring in to do due diligence on something in Cosaic, or you use somebody else due diligence and then verify it?
So we typically do our own due diligence. We hire external people if we don't have the people in the group. So for instance, we did our recent investment, a company called Bio. We hired some precision fermentation experts from the industry to do a due diligence. For the IP part, we have our sister company has a patent office. So there we have our own resources. And when it's like a robotic or automation product, we also have in-house capabilities usually. So it depends a bit on what we know and what we don't know. And yeah, we get external help where required. And then often we share that.
Yeah, that's wonderful. I mean, different divisions can play a role in the due diligence, and when necessary, you bring in an expert and just pay, say, per hour expertise cost to do due diligence on the product.
Exactly. Yeah. So it's again, it's case by case. We do our own research as a team and try to understand sectors. But when we do an investment, of course, more detailed technology and commercial considerations go into play, and we need some help with that as well.
Now, one of the things that many people are trying to understand is, is this whole sector of agri-food tech, is it a VC type investment? Is it a viable financial investment? Because the margins are typically lower than, you would see the same software, obviously in the AI so much. What makes you bullish about this as a sector? Like, why is a family office deploying cash into this rather than, say, another Anthropic or ChatGPT or SpaceX? Like, why is this still a viable opportunity for returns for a family office? I speak with founders raising every day, and they're all telling me the same thing. It's harder than ever to find investors who are actually deploying, and getting access to those leads takes time founders just don't have. Every month fundraising is a month burning runway. This is why we created FTW Plus, a community of founders actively fundraising. The world's most accurate agri-food tech investor database, plus connecting you directly to ideal target investors and a community of support and accountability. Guaranteed results or your money back. Apply today at www.joinftw.com/hub.
I mean, I think the first answer to that is that the family has been successful in agtech, right? So they're the world leader in dairy robotics, and they have been all kinds of other ag businesses in the past, and they know that it's a longer process. So to answer your question, I think it's not a typical VC case, and we see also in the rounds we invest or follow-up rounds in our portfolio that is a struggle to get, let's say, agnostic investors to get on board of this type of investment. And you have the harvest cycles. You have a group of customers that really cannot take too much risk with their produce, right? So yeah, they have 40 chances of making good business in their life, so they don't want to ruin a harvest. And then there's the fact that it's usually hardware where we invest. So there's lots of factors contributing to the fact that it's not for the typical VC. So we often end up working with focused agtech or food VCs, and I think it's a good field for a family office like us because we can have more patience. And we don't want to signal to our portfolio that they can take too much time, but we don't. We're not under pressure to return the funds to the family within a couple of years. So I think our setup well suited for this market. So I think those are our setup is tuned to the market, and the family has experience and success in this industry. So that's why we believe in it.
Yeah, and one of the challenges you just mentioned is you need follow-on capital to scale these technologies. Are you therefore, because of the way you're seeing risk now, are you saying, look, we only want to get into deals that we know we can get follow-on funding in the future? Because we can't lead this thing all the way through, or it has a small requirement on investments. Because or do you have an optimistic view on there's actually going to be more generalist cash flowing into the market soon? Like, how do you look at follow-on cash beyond this round when you look at investments?
I mean, your last question, when do we think that that the market for funding for this kind of agri-food businesses will pick up again? I think it should, right? Because we have been dipping for probably 4-5 years. So at some point the market will come back. We need some good exit and scaling examples in the industry, I think, and then more generalists VCs will deploy more capital in somewhere in the future. I don't know how quick that will be. And so we are certainly, when we invest, we are considering whether follow-up investment will be feasible. But we've also invested in companies where we already knew that it will be tough. And then, give an example. For instance, we reinvested in Saya, which is let's say a robotics solution for greenhouses that completely flips around how a greenhouse works and operates. And there we raised a 10 million round with another family office. So usually, in the end, we find a way, even though generalist VCs may not be as eager as they were 4 years ago. But it's certainly a key consideration and a challenge.
So take that example and open it up for us, right? With this company, right? There was a $10 million round. There's, you and another family office participating. Why was it a good deal for a family office, and why was it not maybe a VC play? And why did you decide to take a risk anyways?
This is they are very innovative on the biology side, on the logistics side, on the robotics side, and they all need to come together and work together. And they're now they have very nice initial deployments, and it's going in the right direction. But we knew when we invested a couple of years ago that it was going to be a long route, and there's no way to shortcut it because you need to scale up the testing and the proof points and develop the technology, and all those different technologies needs to come together. So there was never an easy way out or a quick route to exit. But because of we think the impact that they can make on the industry, we accepted that risk, and that's maybe better suited to a family office than to a VC, which may need to sell in 5 to 7 years, and maybe we could sell in 5 to 7 years, but yeah, it could also take a bit longer here.
And one of the concerns people would mention is some of the bigger players like NVIDIA or whatever, OpenAI, that they could just squash the startup ecosystem, right? There's so much innovation that's coming through from robotics and from AI that really just the sheer scale of a startup won't be able to fund this innovation. What makes you still confident in deploying cash in startups when maybe there's a fear that a bigger player will take over?
I think the hardware component is one thing. So you need to test the hardware in a real life environment with plants or sometimes animals, and that just takes time and years of scaling up and iterations. And so even though you have all the AI compute power that you could have, and certainly that speeds up parts of the process, and software is also a big part of those kind of businesses. But I think the hardware and the testing and the adoption in the real world, especially in agriculture, just requires a certain time and deployment. And we've seen a lot of different startups promising quicker routes to the market with their technology, but we have not seen that materialize ever. So yeah, at least my personal view is that these things just take a couple of years of, even if you have the product ready in a test environment, before you have it ready in a commercial environment, this requires some years of iterations and testing, and there doesn't seem to be a route around it at this stage.
You can't, I used to sell software a lot, very expensive software, and it was just amazing to be able to go to the team like today, and then tomorrow the change has happened.
Yeah.
Biology or robotics doesn't necessarily function. Like physics doesn't function like software often.
Yeah.
It's like, why can't this be done tomorrow? It's like, well, there's, the higher universe created certain, like, why can't we have a baby in 2 months instead of 9 months? It's like, no, so far babies take 9 months to produce. So we haven't gotten like, well, I want to sped up. It's like, well, it's not there yet, maybe, but at this point, it's still going to be 9 months. I'm sorry.
So if you have,
and if you try to do it in 2 months, it'll take a while. It might be problematic.
I totally agree. So if you have a way around it, then I'm very keen to hear it. But so far, and it's also the adoption part, right? So if it's growers or farmers, in this case, what we're talking about, it's, as mentioned, they have their existing business. They cannot risk losing their harvest. So adoption just takes time. And although they're eager to test new technology before they will implement it and let it drive their full operation, that takes some adoption and patience. So
anything else that we should know about the fund or your due diligence? Maybe more importantly, what signals you're looking for? Because we're gonna have a lot of startups listening to this, and they're gonna want to try to understand, okay, should I email a job? Should I do it or not? Can you give us a sense of, like, as to close this podcast out, hey, I'm looking for this right now. Ideally, you should be in this stage. I'm really excited about this area at this moment. If you're this type of founder, I think you should reach out to me. I'd love to talk to you.
yeah, I think, for instance, if you look at alternative ingredients, there we're really looking at the hardware, the process technology that makes the products scalable and affordable for the mass market. So I think Cosaic is an example, or Jaap Bio was an example we invested in last year. We've seen lots of, let's say, strain or precision engineering or precision fermentation, really biotech type of products or developments. We've seen a lot of end products. We're really looking for the link between those two, where also from our machinery and robotics background, we can add most value because we know how to make these kind of processes work. So I think, and then we can, I mean, there are no mature companies, or there are not a lot of mature companies in this field, right? So we're happy to take on early stage risk and develop with the founders if they have a great, really a hardware or a process that unlocks alternative protein for bigger markets.
Okay, amazing.
I can also talk about, if we're more to the ag robotics side, for instance, there it's we're looking for the crucial technology that drives the operation. So it could be climate control, robotics, automation. There's a lot of sensoring there, but then it ends up as a dashboard, and the users look at the dashboard for a couple of months, and then they wonder how to get value out of this. So if it's a combination of very valuable sensor information, but then also a way to have it to enact these type of findings in the field, that's what we find interesting.
Amazing. Well, thank you so much. I learned a ton from your process, and you've really been an amazing winners so far. Some of my favorite entrepreneurs. And I'm sure you're going to get a lot of great entrepreneurs reaching out to you after this podcast.
Thanks.
One more thing. Don't close this episode yet. If you got value from this conversation, here's what I need from you. A 5-star rating, 1 comment, 20 seconds of your time. That's the deal. A 5-star rating means more founders find this content, and every time a founder raises, all boats are elevated. Every week, I pick one random comment and send that person a complimentary copy of Investment Climate, the book. 50 sales playbooks from founders who actually raise money during the fundraising winter. Real strategies, real closes, real numbers, not theory. So if you want a copy, comment below, and if you haven't followed the show yet, do that too. And if there's a guest you want us to bring on the show, just drop us a note or send us an email. We'll read each and every one. Until then, keep on raising.